What's good, everyone, and welcome back to the Financial Four channel. We are on our free money glitch series number 1, giving you an intro on how to completely glitch out the system with intro to options trading part 2. So in this video, we'll summarize what we discussed in part 1. We'll go through an example of an options trade, and we'll just go a little bit deeper into what option contracts are, just the basics, and stay to the end for a hot tip that you can use as a trader or investor. So if you have not watched part 1 of the intro to options, please do before you watch this video, okay? Everyone else, grab your notebooks, buckle up, hands and feet inside the right at all times. Let's go glitch this money. So in the previous video, we went over the 2 types of options. There's your call options, and then there's your put options. So understanding what each of these are and how they work will help you determine when and how to use them. All right. So the buyer of an option pays a premium to the seller of an option for the right, now the obligation, to take delivery of the underlying contract or asset. So this financial value is treated as an asset to the option buyer and a liability to the seller. So when you look all this stuff up, they put in a bunch of confusing language so that the common man can understand. All this really means, call option contracts allow the holder to buy the asset at a certain price within a certain time frame, and put option contracts allow the holder to sell the asset at a certain price by a certain date. Okay, so we also talked about what 2 key components option contracts are made up of, which are your strike price and your expiration date. So the expiration date is basically simply the specific expiration by which the holder must exercise their option. Is basically just a time limit. Okay, and then the strike price is the price at which the buyer of a call option has the right to purchase the contract, or the buyer of a put option has the right to sell a contract, also referred to as the exercise price. And then we also talked about the pricing or valuation of option contracts, right? The formula for the option contract is the extrinsic value plus the intrinsic value, right? That is the option contract's price, right? And so let's break that down. So the intrinsic value of an option is the amount of which the market price is higher than the strike price for a call option contract, or lower than the strike price on a put option contract. In other words, the intrinsic value is the amount of money that the option would be worth if it expired today. And remember, for the option to even have intrinsic value, the option must be quote unquote in the money, ITM. It must be profitable. All right. And so what does that mean? What does in the money means? So remember, there's in the money, ITM, there's out of the money, OTM, and then there's at the money, ATM. To keep it short, out of the money is the stock price is below the strike price. At the money is the stock price is at or almost equal to the strike price. And then the in the money, ITM, is the stock price is above the strike price of the contract, right? So back to intrinsic value. The intrinsic value, as you can see, of the in the money ITM 177.5 calls for Apple is technically $2.04, right? We get that by taking the current stock price and subtracting it by the strike price. But remember what I said in the last video, you then take the $2.04 and multiply it by 100, because each contract is made up of 100 shares. So therefore, the intrinsic value equals $204, right? So as you can see, the intrinsic value of an option, can easily be calculated, but the extrinsic value of an option is basically impossible to estimate other than the expiration of this, because the extrinsic value is made up of a combination of demand, volatility, and time, which we'll cover in a second. And by the way, I'm going over this stuff because I know some of y'all didn't go watch part 2, like I told y'all, right? So if you already know about all this stuff, you can just skip the stuff about intrinsic and extrinsic value. But now for extrinsic value, again is based on a combination of demand, time, and volatility. All right. So demand, if the number of traders willing to buy an option at a given price is greater than the number of traders willing to sell the same option, the value of that option appreciates because it's in demand. All right. And then time, the longer the amount of time until the option expiration, the greater the time value of a particular option will be. All right. And then volatility, if the price of the underlying contract is fluctuating a lot, there is a chance of both a greater profit and loss potential, right? Basically, volatility is how stable the contracts are. All right. So as you can see, due to the number of components, again, it's impossible for to estimate extrinsic value. Some traders will sometimes ask, like, if I buy a call option contract and the market goes up X number of points, what will that contract be worth? Well, unfortunately, the answer depends on factors that can't be necessarily measured quantitatively. Okay. And so now we'll just finish off with what they call option Greeks, right? So option Greeks are used to measure the risk of an option and to gauge an option sensitivity to variables that make up that risk. These variables are represented by Greek letters of what they call delta, gamma, theta, vega, and rho. All right. So basically, option Greeks are just an estimated mathematical sum of demand, time, and volatility. Okay. So we'll just quickly go through these because option Greeks can play a part in the value of your contracts when you're in a trade. They basically dictate the value of an expected change in an option contract. All right. So the first and biggest and probably most important one is theta, right? So theta represents the rate of time decay of an option. So it represents the option's expected daily decline due to time, right? So theta decay can activate if you're in a trade too long on like short expirations, especially on expiration days, right? So let's say it's March 26th and your contract expires that day, theta decay really begins to kick in. And the value of your contract will decay if, let's say, you're betting on the stock to go up and it's taking forever for the stock to go up. And then 2 hours go by and it finally goes up, but you didn't make as much money because it took so long, right? One thing we'll talk about in the future is timing. Timing truly is everything in the market, right? And then that's something very important to note about theta. And then there's delta. Probably the second most important. Delta represents the expected change in the option value for each dollar change in the price of the underlying stock. And then there's gamma. Gamma represents the expected change in the delta for each dollar change in the price of the underlying stock. And then you have like vega. Vega represents an option's sensitivity to volatility. So it represents the expected change in the option value due to changes in volatility expectations for the underlying stock. And then you have rho. Rho represents how sensitive the price of an option is relative to like interest rates, right? So it estimates changes in the option value to changes in what they call the risk-free interest rates, usually like T-bills. Option price changes attributable to interest rates are much smaller. So this last Greek rho, you don't have to worry about much about this one. Okay. So basically, typically, once you become a good trader, you won't even be thinking about the option Greeks while you're trading, except occasionally the delta and the theta Greeks. If you are trading future contracts though, futures with an S contracts, which, that's something we'll discuss down the line, they are not affected by things like theta decay and other Greeks, okay? And then finally, just a hot tip here for those that stay to the end of the video. If you are day trading which we'll soon discuss in our stock course. I highly recommend picking weekly at the money or slightly out of the money option contracts to get the best profits and liquidity. And typically what I like to do is pick contracts that are between $1 and $2.50 if I can. Those always move the best. And that's what you want, right? For swings, please pick slightly out of the money contracts that expire 2 to 4 weeks out, because you are swinging, right? You want to give yourself time for your trade to play out. What's a swing? A swing trade is simply a trade that you hold overnight or over multiple days. All right. So, if it's March 4th, don't pick contracts that expire on March the 8th. Pick contracts that expire like March 22nd or March 29th or something like that. All right. That's for swings, right? So this finishes up our intro to option module. Trust me, we will come back to the topic of options in the near future. Matter of fact, we will have a whole series dedicated just for options, because it's very, very lucrative and important in the stock market. But in our next video, we'll begin to finish off series number 1 of the Free Money Good Stock Course with part 1 of 2 of the most important components, I believe, in the stock market: risk management and price action, which, by the way, are very important to you as an options trader, right? So believe me when I say you cannot miss the risk management and price action module. So be sure to like, comment, and subscribe, and turn your notification bells on for all the free stock course videos. This is Bradley Barnett. I love y'all. From yours truly, Financial Freedom.